Okay, be good to get started. Keep us on time for our final session today. It is my great pleasure to welcome Jim Alm. Jim has a PhD from the University of Wisconsin and then a very long and distinguished career in academics as well as policy advising. He's had positions at Syracuse, at the Maxwell School, the University of Colorado, Georgia State, where he even spent a stint as the dean of the Andrew Young School of Policy Studies, and then moved to Tulane, and he is now an emeritus professor at Tulane. I think of Jim's research in being a variety of areas. He's done a lot of research on the taxation of the family. And for those of you, I know last night there was a sense of who would come to a talk at 8 p.m. President Mandel said this. It's like she showed up right at 8 and nobody seems to, how many people are going to come see something of a tax at 8 o'clock at night? And I said, well, you should come tomorrow afternoon because Jim's the sort of person that's written some papers with titles such as Amazing Grace, Tax Amnesties and Compliance, Till Death or Taxes Do Us Part, Income Taxes and Divorce, or the really catchy title, Shacking Up or Shelling Out, the Income Tax, Marriage, and Cohabitation. So, he's also done an extensive amount of work on tax compliance. He was one of the pioneers of using lab experiments in thinking about tax compliance, including writing a paper with our own Sarah Jacobson, surveying that literature. But the reason he's here today is thinking about tax reform and administration in developing countries. He is part of in putting together this conference, we have brought in, you might have noticed, a lot of younger scholars. And this week I realized how much younger they are than I am. And that's great because it shows the flourishing research in this area. I mean, it's great research going on. But I also wanted to have someone on the program that ties us to an older tradition in public finance and development, a tradition of people going and talking to people in various countries. And Jim has made many, many trips, many of them to Jamaica. I wonder why so many of them were to Jamaica, but Bangladesh, Indonesia, Egypt, the Philippines. In fact, he's covered Africa from Egypt and Tunisia to South Africa with Uganda and Nigeria in between, Turkey, China, Russia, Hungary, so all over the world. And usually when I think of the people who do these sorts of missions, they have their thing. Like they go and talk about decentralization or they go and talk about the VAT. But Jim is like a Swiss Army knife of this. In some countries he was talking about decentralization. In others it was the corporate tax, the personal tax, and on, and compliance issues. So it's an impressive breadth in thinking about taxation in developing countries. And for this combination of academic research and policy advising, this past fall Jim was given an award by the National Tax Association, the Daniel Holland Award, for lifetime achievement in the study and practice of public finance. So it's my pleasure to welcome Jim to give his remarks on linking tax reform with tax administration reform.
This is kind of an out-of-body experience. Thank you, Bill, for those extraordinarily kind words, some of which are true, but probably not all of them. Many thanks also to John and to Q, and especially to Lisa, who makes things work here. It appears to me, for bringing me here to Williams College and the center here for this wonderful conference on taxation and development. I don't know that I can tell you, many of you, anything that you don't already know, but hopefully I can put a different perspective on some of these things and perhaps provide some links that you might not have thought about before. In any event, it's an honor to be here. I have to say also that attending conferences like this always you'd think I would learn, but they always remind me of how little I know about so many things. When I hear talks from Lucy about the political dimensions of taxation, or about vertical and horizontal equity of the property tax, something I hadn't really thought about, from Michael and from Augustine, on measuring horizontal inequities with Mavish, on putting a lot of this stuff into a growth model by Abdullah. I actually have a paper that you might be interested in. I'll try to remember to send that to you. On non-tax policies, I learned something about that from Richard Byrd, who has, not surprisingly, written about that as well as pretty much everything else in the world. And then measuring the payments under the table. And actually, I had, in hearing you talk about that, it reminded me of an old paper of my own on Jamaica, where effectively we didn't know enough at the time to be able to call it payments under the table, but I think effectively that's really what it was. And I wish I still had access to the data to be able to go back and put things in that context. But I mean, it's fascinating stuff. I mean, and I applaud Bill and Q and John for putting all this together, and for Lisa for organizing it. And thank you for having me here. With that as preamble, let me talk about linking tax reform and tax administration. Most of the time, most discussions of tax reform, and I'm going to overstate some things here, especially in light of the conference and the papers here. But for the most part, when economists talk about tax reform and taxes, they focus on the details of the underlying tax structure of the country. How it should be changed, how it should be reformed in order to achieve goals like equity and efficiency and adequacy and so on. But even so, fundamental to the success of any tax reform, any reformed tax structure, is how it's going to be administered. And that's come through, I think, in a lot of the papers here, most all the papers. There are, I will argue, strong links between a country's tax policies, including any tax reform, and the way in which its administration administers these policies. And it's, indeed, I think I will argue that the success of any tax reform depends intimately on the ability of the tax administration to actually administer the reforms. So, as has been said, somewhat in dispute as to who actually said it, whether it was Richard Byrd or Milka Casanegra or somebody else at the IMF, tax administration is, emphasized on the IS, is tax policy. So you really can't talk about tax reform without talking about tax administration. And unfortunately, with the exception of a lot of the people at this conference here, these links are not always fully discussed or fully analyzed, or indeed even fully appreciated. In fact, most economists, when they talk about tax design, they tend to ignore completely tax administration. Again, it doesn't apply to the people here. And even when they talk about tax administration, and this might apply a little bit more, the focus is almost entirely on enforcement of the laws, which is obviously crucial, but it's not the only component of what a tax administration actually does. If you look at virtually any graduate tax syllabus around the country, and you look in there for papers on tax administration, you will generally be looking in vain. There are not many papers there. Now, again, this overstates things, and it doesn't apply to everybody. It certainly doesn't apply to all economists. Joel Slemrod is an underlying story of a lot of the people here and a lot of the papers here. Joel has made major contributions here. Mick Keene as well. I think the people with whom I've worked, especially Richard Byrd, has talked about this as well. But even so, and I'm not without sin about focusing more on tax policy than tax administration, but I think I've always managed to keep a pretty healthy recognition of the absolutely crucial role of tax administration in its many dimensions, as I emphasized later, because some of my very first projects that Bill kindly mentioned, where I went overseas to work on some of these things, involved working with people like Roy Ball, or Richard Byrd, or Danny Holland, or Charlie McClure, or George Brake, or Carl Shoup, or John Dew, all of whom those names are probably not familiar to most of you here, other than perhaps Dan Holland, given the mention before. But these are giants in the public finance profession. And if you look at winners of the Holland Award, of which for some reason I was honored this last year, all of those people are also recipients. And these are the people that mentored me at the very beginning of my profession and impressed upon me the notion you need to consider tax administration when you're reforming taxes. So with all that as background, here's what I want to talk about. I want to give you, I will be careful. Make sure you give me a heads up when I'm approaching 35 or 40 minutes. It's easy to expand the discussion of these case studies to fill the whole thing, and I don't want to do that. But I want to talk about some case studies to tax reform. Not all the reforms these are mainly reforms that I've worked on. So this is not the whole universe of tax reforms around the world, but the universe of the Jim Alm tax reforms where I've worked. And I think this sets the stage for, why do we reform taxes? Well, it's to fix all the problems that are identified in these case studies. And so I'll identify, at the risk of generalizing too much from these experiences, some common problems with tax systems. And then talk about excuse me, I need to stay here a little more diligently. What are the lessons from tax reform that we've learned? And all that then sets the stage for what is exactly that tax administrations do. And I think thinking of tax administrations as tax administration as a production function with inputs leading to outputs, but outputs not simply organized around revenues, but around other things is useful. That's a Richard Byrd contribution. And then talk about reforming tax administrations. And here's where I think a point that is probably not as come out as clearly as I think it probably should be, is that reforming tax administrations involve not simply trying to get better enforcement, but trying to do multiple dimensions of what tax administrations actually do. And I'll talk about that. And I'll finish with some conclusions to summarize. So if I don't get here within the next, what do I have, 2 hours? Is that what you said? My main conclusions are, I always use that joke with graduate students, and they don't laugh at it, unlike you, I will say. A successful reform of a country's tax system requires also a successful reform of tax administration. And I think that's a theme that many people here have already talked about. And so I'm not telling many of you anything you don't already know. But I think, but also that successful tax administration reform needs to be more broadly considered, not simply looking at enforcement, but at some other dimensions of that. So, I probably don't need my name tag for the moment. So let's look at those. Setting the stage, some case studies, some Jim Alm case studies of tax reform. When we talk about tax reform, I think it's useful to distinguish between, there's at least two dimensions of tax reform. Reforming a particular individual tax, what I refer to as piecemeal. Some other people refer to as technical tax reform or coordinating tax reform. But these are reforms where the basic taxes are kept in place and the reform tinkers with one or possibly more tax in the details of that tax. Comprehensive or fundamental reforms are reforms where the entire tax system is changed, including often the introduction of a new tax or non-tax instrument. Especially like the value-added tax, which is a relatively recent phenomenon around the world, really beginning in the 1980s or so. And some common themes here are going to be not simply the problems that I will emphasize, but the reforms. And those reforms are typically broadening the base in some way, reducing the rates of some taxes, at least in some way, simplification of the taxes often, and also, obviously, given the theme of my talk here, administrative improvements. So here are a variety of piecemeal reforms on which I've worked over the years. And so it gives the years and basically the sponsoring agency here. Jamaica, Colombia, Ukraine, Pakistan, Bangladesh, plus all these other ones. And I'm going to talk about each one of them for 5 minutes each. No, don't worry about that. Don't worry about that. I'm not even going to talk about, I was really going to talk about each one of the five at the very top. I think that's probably overkill because I think you'll begin to get the flavor for what's going on with these countries, these different studies over the years, with just a discussion of some of them. I will emphasize that the very first two that I worked on was Jamaica in '85, and then subsequently again, multiple trips to Jamaica, in '95, approximately '95 and 2005. In Bangladesh, where as part of what was referred to at the time as the Zilla Roads Maintenance Project, financed by USAID, started in '83, and then I returned on a World Bank project that looked not at rural public finance issues, but urban public finance issues, where interestingly the same issues arose, it turns out. So let me look at some of these. Let me start with the first one, Jamaica. Individual tax reform in '85 and then subsequent years as well. No bullet points for this. This is just me discussing it. The setting in '85 is that Edward Seaga had succeeded Michael Manley as the prime minister, and there was a widespread feeling that people were leaving Jamaica. The fiscal situation was a mess and it needed to be reformed. And so USAID assembled a team headed by Roy Ball, but also including Danny Holland and other people like that, Charlie McClure, to examine the tax system, the Jamaica Tax Structure Examination Project. My focus was on the individual income tax with Roy Ball and Matt Murray, names that many of you know. And the issues surrounding the individual income tax, again, my role, were that the rates were very high. They reached at that time 14,000 Jamaican dollars, which is about 3,000 US in terms of the time, 57.5% in the individual income tax. Tax rates were imposed on a very narrow basis and a very complicated tax structure with 16 tax credits. The income tax system was therefore very complicated. There were substantial horizontal and vertical inequities given the way in which some people were taxed and were not taxed, and given the uneven use of the tax credits. And there were clearly administrative issues. We worked very closely with the income tax, and there were virtually no audits, for example. There was virtually no enforcement. I mean, I can go into some real war stories about Jamaica, even though this was before most of you were born. But this was my introduction to, at least not outside of Bangladesh, tax policy. So what was the outcome? And those problems were throughout the tax structure. Property tax, corporate income tax, things like that. They did not have a value-added tax at the time. That was introduced as part of the tax reform by Richard Byrd's work in particular. The outcome, there were very significant real reforms. The income tax was dramatically simplified. Credits were eliminated. A flat tax of 25% was introduced above a very, very high exemption level. And resources were invested in improving tax administration in terms of hiring more auditors, training them in more sufficient ways, some initial attempts at computerization and so on. I will say that after 1985, given political considerations, basically the same problems creep back in. And so if you went to 1995, you could dust off the old 1985 reports and say, well, do the same thing. And certainly when you go to 2005, the same thing as well. But there were some lessons there that I'll talk about. By the way, the one side note on this, on Jamaica, but not on the individual income tax, I was also looking at payroll taxes, where the same problems arose. Payroll tax systems consisted of a variety of taxes and some contributions that funded essentially their Social Security scheme and their pension and their health scheme, as well as some other programs. And the rates were pretty high, and they were added on to this, another 10 percentage points. So it's a very high tax burden on individuals. But the note on that connects to administration is that at one point I was talking to the head of the National Insurance Scheme in Jamaica, and she was talking about the way in which their records worked. And for each employee, there would be a card that would have their contributions over the year and the employer's contributions over the year, and that would multiple cards depending upon how long they've been working. And to demonstrate that to me, she asked her assistant to bring her, the head of the NIS, card, the entire package of cards to show me back. And the administrative assistant came back in 10 minutes and said, "We can't find yours." I mean, this is the head of the national insurance scheme, and they did not have detailed records. So administration was clearly a problem. Okay, jump ahead. Colombia, payroll tax system. This is part of a larger tax reform project, comprehensive reform. I wasn't involved on all aspects of it. I was focusing on payroll taxes, what were referred to in Colombia as parafiscales, some of which provided benefits, so not really taxes, but contributions, if you want to distinguish between those. But the rates were high. They were applied. It made a complicated system of all these different parafiscales. There were multiple ones. It imposed significant burdens on workers in some sectors, so horizontal and vertical inequities were imposed. There were administrative problems with it. The cumulative rates were thought to discourage employment in the formal sector. And so my job was to look at these and suggest reforms, typically trying to lower some of these rates, combine some of them, evaluate them. Most of these parafiscales were never really evaluated on whether or not they were achieving their goals. And what happened with that? Virtually nothing. And I think in part is because, as I'll come to later, one of the lessons, the tax reform, even though it was run by Richard Byrd and Jim Paterba and Joel Slemrod, I mean, they were the head economists, and you can't get a better technical assistance team than those people. This was not really a government of Colombia program. It was the Fed of Sorrel. There was a research tank there, and the government didn't really have ownership of it. And so, they didn't pay any attention to it for the most part. Another one, Ukraine. I think I'll get this one and then I'll jump ahead to the other ones. The setting there, this is a World Bank project that was headed by a former colleague at Georgia State, Jorge Martinez Vasquez, to conduct a detailed examination of the entire tax system. I was focusing on one part of it, and that was the ways in which individuals were taxed. I mean, there was an individual income tax, there were payroll taxes, usual form. They also had a very extensive and very complicated, quote, simplified tax system, for which there was a huge incentive to be taxed under rather than under the individual or the income tax or the payroll taxes, because the taxes were much lower under the simplified system. And so this, at the time, I didn't know enough to be able to call this a notch problem. That's certainly has arisen in recent years. But that was basically the setting. And we made recommendations about being able to graduate from the simplified tax system to the regular tax system, to lower the tax differentials between them, broaden the base. But in the process, we quantified the horizontal inequities in particular, and the vertical inequities and so on. I'm sorry, I'll do one more, just to show my breadth, I guess. Corporate income tax reform in Pakistan, another project by the World Bank, headed up by Jorge Martinez Vasquez. Comprehensive reform, working with the World Bank. We had a lot of cooperation with the government of Pakistan, but it wasn't their project either. And my focus was on the corporate income tax, which was a source of some discomfort for me because I hadn't really done much work on the corporate income tax, and complicated. It involved calculating things like marginal effective tax rates across different sectors and so on. And what my work showed was that the corporate base was really very, very small compared to the size of the business sector in Pakistan, in part because people simply didn't file returns there. So there was a narrow base. There was a reluctance to raise tax rates because of the notion that higher tax rates are going to discourage economic growth, for which there's some evidence, but not. It's more fragile than one might imagine. They had a huge system of tax incentives, and that was really the main source of the very great range in marginal effective tax rates across firms in the corporate sector versus firms in other sectors that were very unevenly applied. And there was virtually no monitoring. There was very little monitoring. Now, a lot of things in Pakistan have changed since then, and Pakistan has been the subject of a lot of really excellent empirical work. One of my former students is actually back at the Federal Board of Revenue in Pakistan, and we're working on projects looking at local government administration of the tax system, trying to estimate a production function for local governments. But not much has happened with that reform. And again, I think partly because more important issues began to arise pretty quickly in Pakistan, and partly because it wasn't a project that the government really initiated on its own. It was imposed upon it. And when that happens, governments don't pay any attention. I'm sorry, maybe I'll skip over the comprehensive reform. Bangladesh, I need to talk about Bangladesh. That was my first project. That's the one where I actually went out into the field and went into the local government tax administration offices and saw the files that were kept in basically the huts of these places, wrapped with red tape, origin of which is red tape. It was British tradition. So the project in '83 was focusing on local governments in rural areas, Zilla parishads. And for the most part, and I was focusing on property taxes. For the most part, virtually zero revenues were raised. These were land area taxes, sometimes property transfer taxes in these areas. There were no records that were meaningful. There was no monitoring. It was a land-based tax, and so it had very little yield, any potential yield anyway. And there was, it was poorly administered. I mean, I actually have some slides here of my trips to rural. I'm joking. Don't worry. I have bored people sometimes in the past with that, but I won't. I'm boring you enough anyway, as it is. In 1997, the World Bank initiated a similar project, this time focusing on urban Bangladesh, poor Shavas, where it was the same problems. The slightly different property taxes, but basically these were taxes where nothing was meaningful was being collected. And furthermore, the local governments, either in the rural or the urban areas, felt they had no control over this. They had no agency. They weren't interested in doing anything. And they weren't interested in having all this great World Bank or USAID work given to them so that they could then improve their tax system, because they weren't involved in the initial formulation of the tax policy. There wasn't any ownership. So those are my piecemeal reform war stories, as it were. Comprehensive reforms, I will only talk about one, largely because it involved working with Paul Krugman and Susan Collins. We were brought to the Philippines by a former academic Filipino economist, Eli Remolona, who was forced out by the Marcos administration and went to the New York Fed. And this was in the period between which the administration of Corazon Aquino, who had replaced Marcos in a people power revolution, and who would ultimately succeed her, and that was Fidel Ramos. And so Eli Remolona, the Filipino economist who had been forced to flee to New York, said, let's bring in this was actually the official name, a high-level tax policy team. Paul Krugman, Susan Collins, I can understand that. They couldn't find anybody to do tax policy, so they ended up coming to me. And so we went out there and spent 2 or 3 weeks in 1991 or so, including talking to Corazon Aquino. I actually have a picture of us with, don't worry, I don't have that with me. And then talking with Ramos and giving him some advice. For the most part, the team the Filipinos were mainly interested in trade policy and avoiding enacting hugely protective tariffs to protect their manufacturing sector and build their own automobile manufacturing company and so on. But they needed to talk about tax policy as well, and so that's what I talked about. And the problems there were very similar to what I've been talking about. Lots of evasion, very poor tax administration, lots of fiscal incentives, virtually no audits of any kind of meaningful way, no monitoring of these tax incentives and so on. And so we made a variety of recommendations, some of which Ramos, when he took power, actually implemented. But in part that was because this was a reform where we did connect with the government, the existing government and the new government. So there was a sense of ownership. I've worked on ones in Puerto Rico, same problems, Pakistan, before the corporate reform, Tunisia, most recently Indonesia with APEG. And the problems tend to be the same. And in fact, that's what we get at. So why reform taxes? What are some common problems? Now, I don't mean to imply that every country reforming their taxes has these problems. but they're not unique for the most part to particular countries. So what are these problems? The standard one, and where I'm sometimes accused by my friends of going into countries and simply raising taxes. That's actually hardly ever true. I mean, I don't do tax raising anyway. And not everybody listens to the recommendations I'm making. But this is part of the motivation for a lot of these countries. They want to, especially in Indonesia, classic example. It's a middle income country, I would classify, I think the World Bank now does. But their level of revenues, despite having a Minister of Finance, Sri Mulyani Indrawati, who visited at Georgia State for a couple of years when we were working with them on things, who is, I think, an exceptional, a PhD from Illinois and went back in economics and went back there. They still don't raise much revenue. There's been a slight improvement, but in the vicinity of 12 or 13% of GDP. And for a country of that wealth and that size, that needs to be significantly higher. So that's one problem, a narrow, shrinking base. Certainly narrow, that explains the lower revenues, but the base seems to be shrinking as evasion tends to increase or not be monitored or decreased. There are often large amounts of potential revenues that are not collected due to evasion and avoidance. There's widespread, big problem, widespread use of special tax incentives, where the standard argument is we have to have these to be able to compete with other countries, with our neighbors. The tax system is also, there's often a claim that these taxes can be used to generate economic growth, and so the argument again, we cannot raise tax rates because it's going to get us out of line with our neighbors, and we won't be able to compete internationally. Again, some truth to that. I mean, but nonetheless, the rates, the statutory rates can be quite high, but the effective rates with the incentives and things like that typically are pretty low. Tax system is really, really, really complicated. One of my lessons from tax reform, keep things simple. That's not usually obeyed. There are enormous horizontal and vertical inequities, and some of the papers here have really reinforced that. Generates all kinds of distortions, whether of a static or dynamic efficiency cost, especially between formal and informal activities, but across the board. And the current tax system is often outdated and basically irrelevant in a lot of ways. For the most part, a lot of these tax systems have failed to evolve in ways that fully reflect changing economic circumstances. Most of these current tax systems, and this is changing some, were designed in a world in which production and consumption of goods were primarily of tangible goods, in which the sale and consumption of these goods generally occurred in the same location, and in which the factors that production used to produce this were pretty much immobile. All of these have changed. It's really hard to identify tax bases because of mobility. It's really hard to know exactly what to tax with consumption taxes, for example. And unlike in that world where factors were largely immobile, in the modern world of globalization, a government in one jurisdiction needs to consider how governments in other neighboring jurisdictions are going to respond. That was not really an issue 50 years ago. It is now. So countries use a tax reform. Oh, and finally, not irrelevant, tax administration is a problem. So what do countries do? They use tax reform to try to address the problems of the existing tax system. This would be easier if you could start from scratch. Typically you can't. You got an existing tax system, you got to reform around it. There is a whole literature on tax design versus tax reform. Actually, the best paper on that that's been written is the one that got George Zodro a dissertation award back in 1980 on optimal tax reform, which does look at essentially these transition issues. I've talked to George and I've encouraged him to go back and revisit that and revise it. And he said, yeah, I probably will, but easier said than done. So what are the lessons what are my lessons from tax reform? I'm going to give you 10 quick ones. This is, for some reason I'm wedded to having numbers 10 or 5 or whatever. There are many more lessons. The important one that is not up here that I will emphasize, I will come to. But the first one is, there's not a one-size-fits-all tax reform. You have to tailor the reform to the specific circumstances. That's typically ignored by a lot of economists, and it's easy to fall into the trap of taking your Tunisia comprehensive tax reform and applying it to Indonesia, or applying it to Pakistan, or Puerto Rico, or whatever. Now, the problems may very well be similar, but the solutions have to reflect the specific circumstances of the country where you are working. And that's why on the ground experience is often pretty important. Reform has to be guided by principles. You can't just, whether it's piecemeal reform or comprehensive, you got to get the prices right. You got to get the ways in which all these pieces fit together. And that requires a plan. This is the longest palindrome that I know. A man, a plan, a canal. Panama. Completely irrelevant to this, but I wanted to get my palindrome in here. Write it down if you don't believe that it actually reads the same forward and backward. You need to have a plan. Third, you have to have leadership. There's got to be somebody to push it. And it really has to be, I should add this here, it really has to be somebody inside the government. The government has to own it, as I'll come back to later. A lot of times the comprehensive reform is better than a piecemeal reform. Now that goes somewhat against standard opinion, but a lot of times a comprehensive reform focuses people's attention on the problems. You know that everybody is aware that the system is broken. There's sufficient time for tax administration to absorb the challenges. And they ensure that all the pieces of the tax reform fit together if you're doing this comprehensive reform right. And it ensures probably, if you change one tax, you can almost always identify some specific winners and losers. If you change multiple taxes, people are going to gain from some tax provisions and lose from others. And so there's kind of offsetting. And the politics of this become a little bit easier. And so comprehensive reform is usually better than piecemeal. Timing's important. And again, somewhat paradoxically, it's better to do these reforms when times are bad, because that focuses people's attention on the problem. Everybody recognizes there's a problem, there needs to be a reform. Empirical analysis, as we've seen throughout here, can be a real challenge in these countries, but I believe it's absolutely essential. A war story from Jamaica. We actually built a very comprehensive database, especially for the individual income tax. And we simulated over 200 different combinations of rates and exemption levels and tax credits and so on, where we could identify, recognizing no behavioral changes, winners and losers. And that really informed the discussion with the government and was essential, absolutely essential to the reforms that emerged. Interestingly enough, and this comes out from some of the papers as well, most of the time when people talk about tax reform, they focus at the central government level. Fair enough. I mean, that's where a lot of the action is. Value-added tax, for example, if it's going to be introduced, probably has to be at the central government level. It's really hard to do that subnational. Not impossible. But you need to pay attention to the intergovernmental dimension. If you change taxes at the central government level, it's probably going to affect what local governments can actually raise in revenues as well. And it will change their incentives. And so you need to focus on the intergovernmental dimension. If the central government abolishes a land tax in China, then there's going to be effects on local governments, and that has to be recognized as clearly it was. Also, tax reform must recognize the impact of globalization. Times have changed. Must consider transition issues. You're not starting from scratch. You have to transition from the existing tax system and modify it in a way that becomes consistent with the final new tax structure that you want. And finally, you have to consider its implementation. If you improve tax administration, but they're still administering a bad tax system, you're not going to get good results. So that leads us to focusing on what tax administrations do. Oh, I'm sorry, I forgot this. That's my first conclusion. Successful reform requires reform. Tax reform requires administration reform as well, for reasons that I just went through. A corollary here is also important that I just went through. Administration dimension is important, but you need to get the tax policy right for the reasons that I talked about. If all you do is improve administration, you're going to be administering a crummy tax system. So, How can tax administration be reformed? That requires, I think, thinking about what it is that tax administrations actually do. And so what do they do? Richard Byrd always emphasized, and I picked up on this, that tax administration can be usefully viewed by economists and by others as the production function, where inputs like personnel and materials are used to produce outputs. And so I'll get to that in some detail, but I also then want to talk a little bit about, and this forms the basis for some of my conclusions, a digression. What motivates compliance, and how does that relate to what a tax administration does? And how can tax administrations use these lessons? And then we'll get to more of the specific things that administration should do. So tax administration is the production function. Now, a tax administration exists primarily to raise revenues. So its basic tasks are going to be to assess tax liabilities, collect these taxes, enforce the tax laws, clearly. So what might these inputs and outputs actually include? Well, on the outputs, they can include things like ensuring the integrity of the tax base, providing effective risk management, who you're selecting for audit, supporting voluntary compliance, ensuring on-time payment of taxes, things like that. On a broader level, it might include higher tax effort, might include lowering compliance costs, it might include political acceptance of the tax administration, less official corruption. I will say that the empirical analysis of tax administration has made significant strides in the last 15 years, in large part because, well, the person who took advantage of this was Joel Slemrod, not surprisingly, but largely because OECD has published information, comparative information, not entirely useful comparative information, as I have found in some of my own empirical work with Denville Duncan, but nonetheless, especially at the subnational level, doesn't have much useful information there. But includes broader things, and I've gone back, and the second aspect of getting the data, aside from OECD, is that the IMF has implemented a program called TADAT, T-A-D-A-T, Tax Administration Diagnostic Assessment Tool. Mick Keene was a big pusher of that, and I was asked actually as I think about it, an unpaid consultant to advise about what things should be included in that. And so what they've ended up with is a framework that's been applied in lots of, over 100 countries now, not always making that information available, about inputs into tax administration and immediate outputs, policy outputs of this tax. So doing empirical work is easier now than it was 15 years ago. Well, still hard, still hard. What about inputs? Most basic input is information. And in fact, if I had really the 2 hours that Bill and John promised me, I would talk about technology and how technology affects tax administration. That's an entirely different lecture or keynote or whatever, which I have. I won't do that here. But other inputs might include the standard things about labor force and auditors and lawyers and capital inputs. I actually have a paper that tries to estimate what it would cost to introduce from scratch a brand new tax administration. Where might that be relevant? In Middle East countries that have relied upon oil revenue. So this was estimated for Kuwait. If anybody's foolish enough, I can send you the reference for that. So all kinds of inputs, but technology is crucial. And the end result is that it leads to a perspective on tax administration as how do you combine these inputs and to produce whatever outputs that you want to define, whether they are narrowly defined, higher tax revenues, or more broadly defined, less corruption, more satisfaction with the tax administration. But because enforcement is crucial, I think it's important to talk a little bit about what motivates tax compliance. What things should the government be considering when they're talking about getting people to comply? So I've done a lot of work on this, and I can summarize a lot of these lessons from 12 lessons. I'm going to skip these 12 lessons. I can send you the presentation. But here are the main lessons from these 12 lessons. Individuals, all this work on compliance, whether laboratory experiments or whatever, or field experiments or administrative data, suggests several things. Individuals are clearly influenced by narrowly defined financial incentives, as determined by audits. But they're also influenced by non-financial considerations, guilt and shame and morality. And the evidence on this, I think, is pretty strong. It's not ironclad evidence, it's an area for future research, but still pretty strong. They're influenced by information and the ways in which cognitively they process this information. This is where behavioral economics, my famous paper with Sarah, comes into play. They're influenced by social considerations. People are not an island. They're influenced by what their neighbors are doing. Network effects matter here quite significantly, conveniently summarized by a social norm. And in particular, individuals are different. They're complicated. You can't represent tax compliance by a single representative tax agent. You need to consider what the late great Stephen Jay Gould described as a full house of behaviors that capture all the different motivations that guide people and so on. So how can tax administration use these 12 lessons? So people are complicated. Even so, the evidence on motivation suggests you got to have enforcement. No doubt about that. But you need also to make it easier for people to pay taxes. Services matter. And tax administration and government itself must be seen as treating people fairly and honestly, giving people something for their taxes. And so this leads to 3 paradigms for tax administration. The detection paradigm. This is work Benno Torgler and I came up with this, and Jorge Martinez Vasquez and I came up with this. And actually the World Bank has a framework that is virtually identical with one exception. An enforcement paradigm. That has to be present in tax administration. But you also have to have a tax administration that has become more consumer friendly. And the way in which the World Bank framework differs from mine, they call this facilitation rather than service. Facilitation. I didn't think that was a big difference. They could have kept the service and kept my citation in there, but they decided not to do that. And finally, trust. Individuals are more likely to respond either to enforcement or to services if they believe that the government generally and the tax administration specifically are honest. So trust matters. And again, the evidence to support these paradigms is not ironclad, and that's why additional research is necessary, but I think it's pretty convincing. And this framework provides my framework for thinking about how to reform tax administration. So here's where I'll finish up. Reforming tax administration. How do you do it? Well, you have to have political will to do it. You have to have a strategy or a plan. I could tell you my palindrome about, yeah, I do. You have to have adequate resources. But the most important ingredient for effective tax administration is a clear recognition at the highest levels of government that will support the tax administration, even if it angers some of the supporters of government, even if political friends are hurt. And these 3 ingredients are also essential for reform of a tax administration. So what should you do? A second important lesson, in my second main conclusion, is that you need to increase enforcement, but you need to go beyond enforcement to these other 2 paradigms of service and trust to make a reform of the tax administration especially effective. I believe there's persuasive evidence that tax administrations are most effective when they are based on all of those paradigms. So you have a full house of strategies, administrative strategies, 3 paradigms, to address that full house of individual motivations for why people pay or don't pay their taxes. So my second conclusion, you need to go beyond simple enforcement issues. You need to be generalized from that. And if there's one thing you take away from this whole talk, it's going to be that issue. So what does a comprehensive tax administration reform look like? I won't go into the details. I can if people ask questions about it. But this, for each of the paradigms, I think combining reforms suggested by these 3 paradigms into a single overall strategy has been shown in other reforms to be more effective than just focusing on enforcement by itself. And there really haven't been that many that do only services or trust. And trust is particularly hard to change at the, probably impossible at the central government level. At the local government level, I think things are different, as demonstrated by a lot of the work of the people here. So, conclusions. You need to reform a country's tax system. You need to reform the tax administration. But you need to do a tax administration reform that looks beyond enforcement policies alone, to consider all the different things that motivate people. You need a full house of strategies, because there's a full house of behaviors out there. You can't reduce people's behavior on paying taxes to one single cause or motivation. There's multiple motivations. And so that's why you need, I think, these other strategies. So there are no easy fixes. But I think we know enough to take initial steps. We don't know enough on all things, and that requires more research. But I've already run too long since I don't have 2 hours, and I will stop there. And if you have questions, we can talk about it individually, or maybe in your questions I can try to go into some of those specifics. Thank you.
Okay, we do have a few minutes for questions. Not going to let you off the hook that easy. Any questions?
Thank you for the presentation. My question is, like, you mentioned that like for reforms, it's better to do in bad times. What's your stance on this? Like, why? Because, like, if the economy is already struggling, and we are and it's not just a single type of reform, it's comprehensive reforms. So wouldn't it be like more damaging for the economy, or like?
Keep in mind, these are my lessons. Not everybody agrees with that. I mean, a standard line is that when's the best time to fix a roof? Not when it's raining, not in bad times, but in the sunshine. The reason I argue for bad economic times is, again, what you need to do is generate support for a reform. And in bad times, it's more likely that there's going to be, and this is my experience in Jamaica and in, well, especially in Jamaica, and actually in the Philippines too, to some extent. When there are bad economic times, it focuses people's attention on the problems. There's a kind of a consensus, things are broken. We need to fix it. Part of the fix is going to be tax reform. Maybe not the only part. You know, I think Lucy, one thing I took away from Lucy's analysis is that, this would be a sub-principle as well, is that you really should consider not taxes by themselves, but the way in which taxes interact with, for example, the expenditure side, you know, what governments are providing. That would be kind of a comprehensive fiscal reform. I've never worked on one of those, although there are expenditure studies done by the World Bank in places around the world. But on taxes, bad times focus people's attention, and it makes it easier to make fundamental changes, because you can make the argument, if you don't do that, bad times are going to continue. Not everybody agrees. But it's kind of along the lines of the, who was the main advisor to Russia in their big reforms? Harvard economist who went to...
Schleifer or Jeff Sachs?
Yeah. Jeff Sachs, I think, would argue that a Big Bang theory. You make a bunch of changes all at once, as opposed to kind of an incremental gradualist. Evidence on that is not entirely clear-cut. Evidence for mine is not entirely clear-cut. But that would be my reasons for that advice.
A follow-up would be like, do you have like, or like, what's in your mind, or like, what would be the consequences for the economy, like, in like, if we are having the comprehensive changes and there are bad times, so like, how the economy would gonna deal with it, or like?
A sub-principle of, an additional principle of my, principles of tax reform is that you need to make sure that the tax policies that you introduce mesh with the overall economic policies of the country. So you can't be doing things on tax policy that are going to be affecting the valuation if you're doing trade policies that would be affected there. So, I mean, this is why comprehensive. You make sure that in principle, all the pieces of the tax reform fit together and are consistent with the overall economic policies. You know, tax policies, as much as I like to think they are essential for everything, like getting married or having kids, for example. They're not everything. They're not everything. But they are important, and so you need to make sure that they are consistent with what else is going on.
Okay.
Thank you very much. This was a very good presentation, and for me it was like a lecture. So
I apologize.
No. It's actually a compliment.
And I'll take your question, even though I believe that it's the New York Yankees jacket on. I am a Chicago Cubs fan, so I'm one of life's cursed creatures, if anybody knows anything about baseball. So I'm sorry, go ahead.
Okay, thank you. So with all these reforms, I'm coming from a country where poverty levels are so high, like on average, like it's 40%. So my question now is, at what point do these tax reforms take into consideration of the poor when you're reforming them?
Absolutely. Absolutely. I will say that one of my colleagues, actually Roy Ball, former colleague, would argue that you shouldn't use tax reform to achieve vertical equity goals, largely because doing so probably requires pretty significant tax increases on the wealthy. And in a lot of these developing countries, there's a fear that because tax bases are mobile, that's going to cause those tax bases to move. Having said that, an absolutely crucial consideration in any tax reform, I think, you know, when you're talking about distributional issues, you're talking about values, and so this is my judgment, is protecting the poor. And in the Jamaica case, what we ensured was that you did not enter the income tax system until your taxable income was actually higher than the income where the top rate kicked in under the previous system, about 14,000 Jamaican dollars. Very high personal. So, you know, that was a reform that focused on protecting the poor. I would argue that a lot of tax reforms would help the poor more than other groups by, for example, targeting tax evasion where it's taking place. And that tends to be, for the most part, higher income individuals. So you can start, at least the evidence on the United States is pretty consistent. The evidence that I had in Jamaica, absolutely, the evasion. If you looked at the effective tax burdens measured by taxable income, it looked pretty progressive. But when you included our measures of evasion and avoidance, the tax rate went virtually to zero at the top group. And so those tax reforms, despite Roy Ball heading up this Jamaica reform, did address vertical equity considerations. But the main focus, I think, of especially the income tax reform was to make sure that the poor were taken out of the tax net, for the most part. Because it was a flat rate tax, but flat rate tax above an exemption level. So it was a constant marginal tax rate, but the average tax rate declined with income because of the exemption level. So how do you ensure that? I think you ensure it by taking the poor out of the tax system, or making the rates very low, or having features of the tax system that can redistribute income to the poor, like our earned income tax credit, for example. But again, that's why I think a comprehensive reform is better, because those incentives are going to be interacting with personal income taxes and simplified taxes and corporate taxes. And so you need to make sure they all pieces fit together so you get the prices right. And you get the distributional effects right. So that's my answer to a Yankees fan. And it would be the same to a Cubs fan, for that matter.
Two more quick questions.
Thank you, Professor for your insightful review of your lessons learned from your experience. So my question goes to the Ukraine and also relates to my colleague's question also about the crisis time, which is also opportunity for So what would you advise nowadays to the Ukraine to do in terms of tax compliance?
Right
and
now?
tax? Yes. There is a crisis, there is a policy needed, and also you have some knowledge and you worked with this country.
Indeed.
Thank you.
That doesn't necessarily give me any particular crucial insights here. I would say that one of the reasons that are, especially in Pakistan, recommendations in the comprehensive reform, or the corporate reforms where I work, were for the most part ignored, was that around the time that we finished our study, the then president, I think, declared martial law. This would have been around 2010. Yep. And so the point being that, was the government, was the Federal Board of Revenue, where my student is returned and is doing work and where I have some good friends, were they really going to be focused on accelerated depreciation at a time when the country's political system was under threat? I would say the same thing applies even more now. That doesn't mean, I guess, so I don't know what they should be doing in particular right now. I don't know how they collect taxes. I mean, I really don't, given the constant bombardment and so on. But I would say one thing that I would recommend that the Ukraine Ministry of Finance might consider is when the war with Russia is over and we can go back to being somewhat normal, what do we want our tax system to look like? And this would give you kind of an opportunity during however long period of time it's going to take before that actually takes place, to put in place the new tax system that reflects the fact that you've lost enormous amounts of infrastructure, you've lost, lots of people have died. Your tax system probably has to change to reflect that. I have no idea what that would be, because I don't have any idea of the extent of the damage. But I would be doing the planning now, based upon best guesses about when the war is going to end and what taxes might be administratively feasible when the war ends. That would be my advice. And I'm sorry I can't be more specific, but man, that's a tough one. I will think about that, though. If my email is. By the way, I worked in a lot of countries, many of which all of you are from, but not all the ones that you are from. But there's still time. Not much time. That window is closing, I will say. But my email is pretty easy to remember, and it's still my Tulane email, jalm@tulane.edu. If you want to send me something, I will devote some thought to it. I mean, and I will talk to some of my colleagues who have also, Jorge Martinez in particular, who's done a lot of work in. I'm trying to get back to the title page here. So.
While you're doing that, let's see, Michael, who will ask questions?
Thanks, Jim, for a very stimulating talk. I was going to ask you if you could give us some sort of examples or texture or sort of ingredients to administrative reforms that focus on that third element of trust and norms that you might think are promising directions for future work.
Yeah, that's the most examined aspect of tax administration policy, not surprisingly, is audits. Largely, it's easy. Here's an audit. What are its effects? Now, having said that, and this will go against somewhat of the conclusions to say Joel. How many had Joel as a dissertation advisor? You and Sarah and John? So I'm not speaking ill of Joel. I mean, he's had an enormous impact on my own thinking. I will say the only time I think I've ever, quote, beaten Joel was at a NBER conference in Key West. And there was a 9-hole par 3 course. And we went out and I whipped him. Remind him of that if you talk to him. Audits don't always work. Audits do not always work. And the reasons for that are not always fully understood. That's where I think lab experiments and field experiments can be especially helpful. For example, if you audit somebody who's been compliant, a lot of times following that they become non-compliant. So it depends on how the people are selected, but those are some considerations. Services. I have a paper coming out in NTJ that's basically my reflections on getting the Holland Award. And I talk about these paradigms and I identify one main question for each paradigm. And for the enforcement paradigm, it is, why do audits sometimes work and sometimes not work? And I think the best way of examining it is probably going to be lab experiments. Sarah, opportunity here. Maybe we should work together. On services, I mean, there's lots of questions there. I mean, these are just what I thought I would identify as the main one, trying to give some guidance to younger scholars. Virtually everybody in this room is a younger scholar relative to me. And my main research question for services was, despite the common presumption that a simpler tax system will lead to more compliance, the evidence on that is pretty fragile. I have some experimental results and theoretical results, but there was a recent paper actually in France that looked at a simplified tax system. And with the simplified tax system, it was simpler, but people notched or bunched right below the notch. It decreased compliance. So, under what circumstances does it increase or not? And that's a research question I think that's important. And on the trust paradigm, your main question, and then I guess Bill's going to pull the plug here. That's the least examined. That's the least examined. But with the use of a lot of the field experiments, the controlled field experiments that some of you were talking about here, a lot of times in Pakistan, especially in Latin America, done by the World Bank, even though they use facilitation rather than service as the name for their paradigm. I mean, you got to correct them next time you talk to them. They've done a lot of controlled field experiments on how to change the incentives and the trust of individuals with the tax system via for the most part, the local property tax. So some experiments give people more control. If you pay your taxes and that's verified, then we're going to improve your sidewalk in front of your house. Improves compliance. If we give you information on what the neighbors in your immediate area are paying with the property tax, and this is consistent with some of the results here, the surveys that you guys were doing, that can improve compliance. Not always, because if you find out your neighbors are cheating, you might say, I'm going to cheat too. But that's been examined. But in general, these field experiments, Inter-American Development Bank, World Bank, Center for Tax and Development, and so on, often working with outside researchers, have found that if you demonstrate to individuals that your local government is actually trying to provide the services that you demand, streets, sewage pickup, a lot of good experiments, different voting systems. There's some great work by, actually I think a political scientist, Krauss, I can dig up the reference. Yeah, I'm sorry, you probably mentioned that one, right? Well, on different voting systems, basically. And I think those have enormous promise. Now, there's always the question whether or not something that works in Mexico City is going to work in some other place. And a lot of times it doesn't. And so why, we were talking before, why do sometimes they work and not? But the trust paradigm is where I would focus. And one last point, and then I'll quit. I'm actually I have designed, working with an Austrian economist, an economist from Austria, not an and a student there, essentially constructing a fiscal system, a society in the laboratory, where people pay taxes and get something from government of various types. Into that, we're going to try to introduce variations in notions of fairness. Distributional fairness, enforcement fairness. I forget what the other one is. 3 of them. We're going to use some innovative methods to measure, quote, trust in government before and after this innovation, and then we're going to see what the effect is. That's our goal in any event. And that's another way in which one might be able to attack some of this. And again, if anybody wants to send me an email, I'm happy to provide some more information on some of these things. At that point, I know I need to quit.
Let's thank Jim. Thank you, Jim.